Hey everybody, welcome back to another round of Accounting 1101. We are finishing up our series on inventory, talking about the weighted average method of allocating those inventory costs to cost of goods sold and ending inventory. Now, it's the end of our road, but it's not the end of the inventory highway. If you move on to intermediate accounting, you'll learn all kinds of more fun things about inventory, like lower of cost or market valuation. You'll learn about dollar value LIFO, retail inventory method LIFO, all kinds of topics if you make it to intermediate accounting. Look at that. Look at all that fun stuff you have waiting for you in intermediate accounting. When I need a workout here in the office, I just take the intermediate accounting book and I bench it right there and get my reps in. So a lot of stuff to cover in inventory. We are kind of going to just leave it at the inventory cost flows and have a good idea of FIFO, LIFO, weighted average, and then you can worry about the rest if you become an accounting major, which I highly recommend you do, by the way. As we know, the game we're playing, taking that inventory amount that we paid, allocating it between cost of goods sold, what left, what has been sold, and what is still sitting in ending inventory. And hopefully, those two numbers added together equal the cost we paid for inventory. Weighted average is what we're focusing on today. We're going to calculate a brand new average every time we buy inventory. So a little bit more math involved here. And we're going to be making new average amounts every time we buy inventory. We're going to use it to determine cost of goods sold and ending inventory when we calculate a new average amount. And once again, we know in reality, we don't know the physical flow of inventory. So we're just doing a little accounting trickery here, making some accounting assumptions to make that estimation process easier. Using the exact same example we used in FIFO and LIFO, our Monopoly board game here, the exact same circumstances for when we bought and sold, and the exact same template. So let's go ahead and pull that up. There we go. Once again, you can see we've got the date, what we bought, cost of goods sold, and our inventory balance, and our details behind all of the transactions right there. And this time, instead of doing LIFO and FIFO, we're going to be calculating a new inventory balance every time we buy inventory. So we'll begin January 1. It's like Groundhog Day. Same stuff over and over and over again. 1,000 unit at a cost of $20 per. And just go ahead and do the math here. 20,000. Beginning inventory. Right now we only have one layer of inventory. We only have one kind of group. And so the average that we paid is 20 bucks. We sold 700 units on January 4th. Again, we're not worried about the sales price here. We're worried about the cost. We're tracking cost. So we paid $20 per. Total cost, or cost of goods sold on that transaction, would be $400. We have $300 remaining. We had 1,000 units. We sold 700. We have $300 remaining at $20 a unit. $6,000 in ending inventory. So that looks exactly like it did under FIFO and LIFO. But now we're going to buy more inventory on January 10. We're going to buy 500 at $22.40 for a total cost of hashtags. There we go, 11,200. So here's where the averaging comes into play. Every time we buy inventory, we have to make a new average per unit cost. And so we kind of start off with 300 at 20, 6,000 in that layer, 500 at 22.40, 11,200. So let's calculate an average right here. We've got 800 units. We paid for those 800 units a total 17,200. All right, everybody see my math right there? We had 3 and 5. I have 800 total units. My total cost, 6,000 plus 11,200 is 17,200. So to get an average, all I'm going to do is I'm going to take that total cost and divide it by the number of units. So 2150. That's it. That is my average cost per unit. My spreadsheet's looking a little weird here because I got that line out that far, but you get the idea. You can format it however you want to. Just keep your numbers in some kind of way that makes sense to you. 2150, average price of 800 units. Now we move along to January 22nd. We sold 360. Again, ignore the 30. The cost, well, 2150, the average amount. So we're going to pull that number in here. We sold 360, 2150. We're looking at 7,740 and a total cost of goods sold there. We had 800 units. We sold 360. We have 440 left at an average amount of 2150. And so there we have the ending inventory balance. Again, to walk you through that, I calculated the average amount per unit after that purchase. We sold 360. We take that quantity, multiply it by the average per unit to get the cost of goods sold. And at that point, we have 440 left. 800 total minus 360 sold gives me 440. Multiplied by the average per unit gives me my ending inventory. It's as easy or as difficult as that, depending on whether you are a glass half full or a glass half empty person. Me, I'm a glass half full person. Easy as that. January 28th, a half full of half empty cup. We sold 240 units. All right, so we're back here in cost of goods sold, 240. Again, we haven't bought anything new, so our price is still $21.50 a unit. Let's make that look pretty. There we go. We had 440, we sold 240. According to my brain calculator, it means we have 200 left over at a price of $21.50. 4,300 left in ending inventory there. So, one more time, we're buying. We're buying on January 30, 600 at $23.30. 13,980. So we had 200 in layer 1 at an average of $21.50. Multiply that out, we get 4,300. And now we've added a layer, 600 at $23.30. There we go. Again, every time we buy, we got to make a new average amount. So let's go ahead and do that. We had 200, we added 600 right there. We have 800 for a total amount cost wise of 18,280. 18,280 divided by 800 gives me a new per unit of $22.85. That's it. And that would kind of be how we would end. Our ending inventory in January would be 800 units, valued at $18,280 for a per unit of $22.85. We'd roll on into February, and that would be our per unit amount for when we sold. If we bought more before we sold, we'd have to calculate a new per unit amount. That's the game with weighted average method. Every time we buy more, we got to calculate a new average. So let's calculate our totals here. Cost of goods sold, 1, 2, 3. 3 numbers right there. 26,900. We already calculated our ending inventory, 18,280. So there we go. And one more time, we'll check to make sure our total inventory cost is equal to cost of goods sold plus our ending inventory. We'll go ahead and do the math here. We began with a $20,000 balance in inventory. We bought 11,200 and 13,980. 45,180 is the total that we have in our cost of inventory. We're allocating it between cost of goods sold and ending inventory. 45,180. Look at that. The accounting inventory gods are smiling upon us now as we've finished up the FIFO, LIFO, and weighted average examples. Let's go back to our PowerPoint here real quick. Weighted average during an inflationary period, again, which is basically always. Prices are almost always going up. Weighted average is kind of the middle ground between LIFO and FIFO. All right, it's kind of the splitting the difference between the two. Best Buy, to give you an example, is a big corporation, a big company that uses weighted average method. You can see in their notes the financial statement. Merchandise inventories are recorded at the lower of cost or net realizable value. Hey, like I mentioned before, intermediate accounting. If you want to learn about cost, net realizable value, the lower of the two, there's the class for you. I'll see you there next year maybe. In the meantime, the weighted average method is used to determine the cost of inventory. So now you can read that note in the financial statement. You can read notes about FIFO and LIFO and have a little bit of an idea as to what's going on. Speaking of what's going on, if it's homework and if you have questions, you know where to get help. Just a click away. The email address is right there. Reach out if you have any questions on your LIFO, FIFO, weighted average problems. As you get those questions to me, it's helpful if you send me a spreadsheet. Let me see your math. That way I can maybe pick out where you've gone wrong. Helps steer you back in the right direction. That wraps up our talk in 1101 on inventory. We'll come back and we'll talk about property, plant, and equipment. We'll talk about accounts receivable and how to handle it when people don't pay what they owe. All kinds of fun stuff coming down the pike. So I hope to see you back here for all of that. In the meantime, take care, everybody.